If you are in your late 30s or early 40s and feel a pit in your stomach every time someone talks about compounding interest, you are not alone. Almost every financial video on YouTube starts with the exact same advice. If you had just invested $200 a month starting at age 21, you would have become a millionaire by age 60. Okay, but what if you didn't? What if life happened, debt happened, or career pivots happened? Hello, I'm Kit. And yes, you're looking at my AI digital twin, a tool I use to protect my corporate privacy while sharing real financial systems. In my 20 years in corporate finance, I saw senior professionals making six figures who had virtually zero invested wealth. Guilt and shame will not build your portfolio, but a clear, aggressive strategy starting today absolutely will. In his best-selling book, The Psychology of Money, author Morgan Housel points out that everyone's financial timeline is shaped by their unique history. You didn't start late because you were irresponsible. You started when your life allowed you to. The good news? Starting in your late 30s or 40s comes with massive strategic advantages that people in their 20s simply do not have. When you're 22, you have time, but you usually have very little spare capital. When you're 40, your earning power, professional maturity, and ability to make serious moves are at their absolute peak. A late starter who saves aggressive capital can easily catch up to a 20-something who is investing pocket change. It is not about when you started. It is about your current trajectory. As James Clear writes in Atomic Habits, your outcomes are a lagging measure of your habits. Your net worth is a lagging measure of your financial habits. You do not need 20 years of compounding to create meaningful freedom. You just need a system calibrated for where you stand right now. Let's break down the exact 4-step catch-up blueprint. The very first step is understanding the importance of your savings rate in wealth building. Therefore, step 1 is shifting your focus from investment returns to your savings rate. When people feel behind, their first instinct is to look for high-risk shortcuts. Crypto moonshots, speculative stocks, or get-rich-quick schemes. But financial math shows that in the first 5 to 10 years of your investing journey, your savings rate matters far more than your investment performance. If you invest $1,000 at a 10% return, you gain $100. But if you optimize your career skills and trim corporate stress spending to save an extra $500 a month, you've boosted your portfolio growth by 500%. For late starters, your primary engine is not picking magic stocks. It is expanding the gap between your income and your living expenses. Keep the strategy ridiculously simple. In The Simple Path to Wealth, J.L. Collins advocates for low-cost total stock market index funds. When you are catching up, you cannot afford to waste energy or money on complex Wall Street products, expensive advisors, or heavy management fees. You want broad market exposure that grows automatically over time. Therefore, because you are starting later, your portfolio design needs 2 simple layers. Core growth assets, like total market index funds to build wealth, paired with a solid cash buffer to protect you from market downturns. You don't need a complex multi-asset portfolio. You just need simple, low-cost index funds and ETFs working quietly in the background. Late starters often fail because they try to rely on willpower every month. What you can do instead is set up automatic transfers on payday that move money straight from your paycheck into your investment accounts before you even see it. This is how you build an automated financial engine. When investment transfers happen automatically on the first of the month, you eliminate the cognitive friction of deciding whether to invest or spend. You remove emotion from the equation entirely. You adapt your lifestyle to whatever is left over, making your wealth growth invisible and completely effortless. Step 4. Reframe your retirement target. Traditional media tells you that you need $3 million by age 65. But in his book, Die with Zero, Bill Perkins challenges us to look at money as a tool for buying time and experiences, not just accumulating a giant arbitrary pile of cash. You might not need millions to be free. If your goal is to exit corporate stress as soon as possible, you don't need to fund 40 years of total idleness. You might only need a liquid cushion that allows you to drop to part-time consulting, launch a quiet business, or take a sabbatical. When you redefine what retirement means to you, your required financial runway becomes significantly smaller and much easier to achieve. Let's look at the actual math inside the Freedom Dashboard. Imagine you are 40 years old today with modest invested savings, let's say $17,000. If you leverage your senior earning power to invest $2,200 a month into a standard market index returning an average 8%, an ETF returning 7%, bonds at 6%, and real estate at 5%. Let's look at where you stand by the time you reach 50. In just 10 years, by age 50, you have accumulated over $388,000. Is it a $10 million fortune? No. But combined with a lowered baseline living cost and high-value corporate skills, that well over $250,000 provides absolute flexibility. It gives you years of defensive runway and complete psychological control over your career decisions. The worst thing you can do at 40 is nothing, simply because you wish you had started at 25. 10 years are going to pass regardless. In 10 years, you can either be 50 with zero cushion and the exact same corporate anxiety, or 50 with $250,000 safety net and total control over your schedule. Regret is an expensive emotion. Every dollar you invest today is a worker you deploy for your future self. You aren't playing someone else's financial game or trying to beat 20-year-old day traders. You are simply buying back your own future autonomy. To recap our late start blueprint, stop dwelling on lost time. Maximize your savings rate using your peak corporate earning years. Keep your portfolio dead simple with automated index funds, and define your exit strategy based on personal runway rather than traditional retirement myths. Take 30 minutes this weekend to look at your actual numbers. Figure out your true monthly baseline expenses. Set up your first automated savings transfer, even if it's just a couple $100s to start with, because this is what will get your mental focus to shift and gradually accept that this is the norm, that investing every month is just the natural thing to do. If you want to use the exact spreadsheet models I use to calculate runway and track late start growth, grab the template linked in the description below. Thank you so much for watching. Don't forget to drop a comment letting me know your late start goals. Hit subscribe for next week's video, and I'll see you on the runway.